In economics, we study about moral hazard, which means you create a system that is going to give incentives to individual economic actors like banks, corporations, and individual businesses so that they can go out and make riskier bets, riskier decisions. Because they know that if they struggle, they go bankrupt or they go bust, the system is going to protect them. In this video, we're going to talk about how today's event is going to create more moral hazard in the economy. And let's get right into this. So if you're new to my channel, my name is Yasin Nizami, and I make these videos to educate my audience about the real estate market in Canada, particularly in GTA, as well as some macroeconomic factors, some geopolitical situations, and some investment strategies as well. So if you are interested in any of these topics, consider subscribe, and let's get back to our topic of the day. So what we saw from Federal Reserve and US Treasuries that they are going to bail out the banking system. So they announced two things. Number one, they increased the FDIC limit from $250,000 to almost infinity, which means if you have $100 million sitting in your bank account and if the bank go bust, don't worry, the system, the Federal Reserve, the Treasuries will going to protect you. They will actually insure your entire deposit. That's what pretty much they said. They are going to insure all the deposits in the banking system. Number two, what they announced is actually a bailout program. They're not technically saying it, but it is exactly a bailout program for the banks. So what they're saying to the struggling banks who have some garbage collateral like mortgage-backed securities, or they have purchased some other loans and they don't have the pristine collateral like US Treasuries, or T-bills. So the Federal Reserve is saying to the banks, don't worry guys, if you have those collaterals, we will buy those collaterals at the face value, so that those banks get rid of that garbage collateral and they can restart their balance sheet again. So basically they are allocating a fund of $25 billion, which I believe is going to expand because it started with Silicon Valley Bank and Signature Bank, and I'm sure it will go beyond those banks, because what we are seeing is a systematic trouble across those regional banks and smaller banks where they did not even properly manage their balance sheet and they did not protect their assets from interest rate hedging. So by doing that, Federal Reserve is kind of creating a moral hazard by sending this narrative that Mr. Banks, you do whatever you want to do. You can make riskier bets. You can do poor balance sheet management. Don't worry about it if you go bust, because we will come and protect you. We will bail you out. This is going to create a massive issue in terms of the way the system works, because think about it. If you're a bank, if you're a smaller bank, and somebody comes to you to take a loan to create a factory to produce something, you will see this as a much riskier investment, because you don't know how this project will work out, if you will get your ROI back or not. But you know that if you buy some treasuries, you will have fixed income guarantee. But if you even go bust, you are secured and backed up by Federal Reserve. So this creates a system that is going to put money into unproductive assets, but not the productive assets, which is going to create goods and services in the economy. So that's the system we are creating, right? And what if I tell you that this system is also going to pave a way for CBDCs? Would you believe me? You wouldn't, right? So what the Federal Reserve is doing is basically by using this bailout program, they're going to make the commercial banks completely useless, right? Because whatever they can do, they know that they will be backed up by Federal Reserve. So the balance sheet doesn't really matter anymore in the economy, right? Because Federal Reserve will own those assets on their balance sheet, okay? And if that's the situation, that means those commercial banks, they're not needed anymore in the economy. So they can be easily replaced by one entity, which is Federal Reserve. And what does it mean? It means CBDC. So every individual actor in the economy will have account with the Federal Reserve, and Federal Reserve will have everything on their balance sheet. All the liabilities will be on Fed's balance sheet. That's the path I'm seeing. Again, this is all speculation, but it's all my observation as well. So you tell me, what do you think? And Federal Reserve and Treasury Secretary Janet Yellen is saying all of this, funding is not on taxpayers' budget, because I don't know where this money comes from. Even if they're printing money, somebody has to pay. There's no free lunch, guys. And what they have told us, that they're going to take that money from their exchange reserves, which is emergency fund to protect US dollar in the form of any chaos in the currency market. So basically they are using those funds to bail out the banks which are being bankrupt because of their stupid poor management. Now at the end of the day, it's us going to pay that, right? The insurance is going to go up. The insurance premium is going to go up from FDIC. Who's going to pay? Not the banks, us. Yes, banks will pay the premium, but banks will also charge us that premium from a overall economy perspective. So at the end of the day, it's going to be us, you and I, paying this whole bailout, and this is going to create a moral hazard. This is what we're heading, guys. That is the system that they have created, and it's not benefiting a common person, but a small portion of wealthy individuals and global elites. They are taking all the benefit of it. You let me know what you think, and I'll see you in the next video. Take care.